Here with us now to discuss it all, Marc LoPresti, CEO of Market Rebellion. Marc, always good to see you. You and I were talking during commercial. It's a busy week when it comes to finance. I want to start with those corporate earnings. I want to read something for our viewers from the Wall Street Journal. This is what they said, quote, top and bottom line results from companies in the S&P 500 are handily beating expectations that had been lowered after President Trump announced sweeping duties on imports in April. While much of that earning growth has been driven by tech companies, corporate chiefs also have sounded more optimistic about the economy than they did in the spring. End quote. You and I were talking about this. Are some sectors weathering the president's tariffs better than others, and which ones?
Sure. Well, first of all, 82% or 83% of companies that have reported thus far have beat or exceeded what the street was looking for. Earnings per share at a level we've not seen in about 5 years.
Wow.
So earnings season thus far, Hannah, has been spectacular. There's a little bit of a bias in the numbers there because tech has reported the Mag 7, as we were talking about during commercial. We have big box retail this week, Lowe's, Home Depot, Target, a lot of the companies that Wall Street looks to for an understanding of how the American consumer is doing.
And how much they're spending.
That precisely. And the extent to which those companies are passing along the costs of these tariffs to the consumers. Thus far, they have not. To me, those earnings reports are as important, if not more so, than Jerome Powell's on Friday from Jackson Hole.
We have to say the data on inflation, that hasn't been so great. We just saw wholesale prices make their biggest jump, I believe, in 3 years. Consumer prices also heading in the wrong direction. Could those trends get worse if companies stop being able to absorb the costs of the tariffs, like you mentioned, alluded to, they have so far?
The short answer is, of course, it could get worse, but it's also important to break those numbers down a little bit. The PPI numbers that we saw last week, what companies pay for the goods that are used to manufacture, what consumers buy, was higher than the street was expecting, Hannah. But almost a third of that came from two sectors.
Okay.
Airlines and the travel sector and services. So what does that mean? You want to see inflationary growth. You want to see services go up. That actually bodes well for the employment picture. And as I've been saying since the beginning of the summer, we were just talking about our vacations on the break. I think it's going to be a gangbusters season for the travel industry, leading with the airlines. So you can't just look at those top line numbers and say, oh my God, inflation is back, we're all gonna.
But is that just seasonal? We're going into the fall.
Of course, but the market understands seasonality very well. August is typically one of the worst months, if not the worst month for the stock market performance, historically speaking, over the past 30 or 40 years. We're going into a seasonality trend now where the market performance tends to improve.
There was a new survey, it's from Bank of America. It finds 70% of global investors are expecting stagflation within the next year. How serious is the risk of a slowdown, especially paired with more inflation?
Well, so stagflation is essentially when growth and inflation go in opposite directions, right? And you don't want that. That's a bad thing. But that's why it's so important for Jerome Powell to finally get off his duff and make that rate cut that we need. Part of the narrative that's not discussed on other networks, and I'm glad we're talking about it here, is if you bring down the cost of capital for corporations by lowering that Fed funds rate, you're going to see increased investment. You're going to see additional employment. You're going to see companies able to withstand the duration of what's left of these trade and tariff negotiations much better than with rates that are as elevated as they are right now. So that's what I'm hoping to see on.
Let's talk about Fed Chair Jerome Powell. Investors are anticipating what he's going to say on Friday. What do you expect?
Well, right now the CME FedWatch tool, which is what we look to determine exactly what the Fed's going to do, it's pretty accurate, by the way, is basically predicting an 85% chance of a first 25 basis point cut when the Fed meets again in September. This is not a Fed meeting in August. This is their annual jamboree, whatever they do in Jackson Hole. They sit around a campfire and talk about God knows what. But you know, if last year is any indication, Jerome Powell was famously dovish last August 23rd, when his comments came out at Jackson Hole last year, basically saying inflation was getting closer to that 2% target rate, that it was time for a policy change. What investors are going to be looking for in reading the tea leaves in his comments on Friday is whether we see any indication of that dovishness, or we're going to see a Fed chair who's continued to say, I'm driven by the data, I'm driven by the numbers, I'm concerned about inflation, I'm concerned about the president's trade wars, so we'll wait and see. That would not be good. The market, as I said, 85% chance of a 25 basis point cut in September. If we don't get that, we could have another little tariff tantrum.
President Trump has been very vocal on what he wants from the Fed chair. Do you think that's going to play any role in his comments on Friday?
Yeah, well, it depends on whether or not President Trump comes up with a new nickname for Jerome Powell between now and then.
Yeah.
He's been extremely vocal in his criticism of the Fed chair, but I think that Chairman Powell is completely unfazed by those headlines.
Yeah, that certainly seems like the case. Marc LoPresti, thank you for breaking it down. It's always very complicated. I appreciate you.
My pleasure.
And The Hill is next with Chief Washington.